Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And today we're going to look into how and why you should use trailing stops in your short-term trading portfolio. But before I do, I want to remind you to subscribe to this channel so you don't miss any of my views or investment commentary. A trailing stop is an order that you place with your broker that allows you to maximize your upside potential and minimize your downside risk by stipulating at what point you would sell the stock at market. For instance, if you buy 1,000 shares at 20 bucks, if you were using, say, a 25% trailing stop, if the stock traded down to 15, it would execute at market. So you might get a little more or less than 15, but that would execute the stop order. Why would you do this? Well, you do this because you never know exactly how high the stocks you own are going to go, or how long they're going to take to get there, or when they're going to peak, or how far down they're going to drop. And so this allows you to stay in the stock as long as it's in an uptrend. And if the stock plateaus and starts coming down, it protects your profits, or if a position goes against you, it protects your principal. So it's just a very disciplined sell strategy. And why should you use a disciplined sell strategy? Well, you would do it because if you're trading for short-term profits, you have to have a mechanism that tells you when it's time to sell. Anybody can plunk for a few shares of stock, but when are you going to sell? You have to have a rationale for when you're going to sell. I don't like price targets on the way up because if you accept my basic premise that you want to hold stocks that are trending up and get rid of stocks that are going against you, if you bought a stock at 20 and it had, say, a price target of 26 and it goes to 26 and you sold it, you might feel bad about that since the stock is in an uptrend when it gets to 30 or 40 or $50 or more. And conversely, if a stock goes against you and it falls to 15, it may hurt to take that loss. But if you don't take a loss, if you're undisciplined, then you can be sitting on a substantial loss. And again, as a short-term trader, if a position goes against you by 50%, if a $20 stock drops to 10, you have to make 100% return on your next trade in order to be made whole again. Now, I've been talking about using trailing stops with your short-term trading, but what about long-term trading? Well, before I get into that, let me mention that I write an e-letter, Liberty Through Wealth. It's absolutely free. I talk about everything that's going on in the markets from week to week, and you can just click on the link below and become a subscriber to that service. I personally have held some stocks, including Apple and Amazon and Netflix and several others, not just for years, but for decades. And I've not only been through every dip and every correction, but every bear market that's happened over those periods of decades. The problem is not every company is worth holding forever or for the very long term. The truth is most companies eventually go out of business. That seems hard to believe, but think about this. When the automobile was first invented, there was quickly more than 100 automobile makers in the United States. In a matter of just a few years, there was only 3. They later became known as the Big 3. So you could have been absolutely right about the future of the automobile and completely wrong, had a 97% chance of being wrong buying auto stocks. People know that the key to making money in the stock market is buying low and selling high. Okay. Now, sell stops have nothing to do with buying. It's about protecting your profits and protecting your principal. But it takes the emotion. It takes the uncertainty out of the investment process, and it gives you a discipline that you're following. And studies have consistently shown that investors, even professional investors who follow a proven discipline, do much better than people who are using subjective measures or emotional reasons to sell their stocks. So that's the reasons why using trailing stops can increase your returns as a trader. If you have other questions about sell strategies or anything else to do with the process of investing, feel free to leave them below in the comment section and I'll address them in a future video. So that's it for today. Thanks so much. This is Alexander Green, Chief Investment Strategist with the Oxford Club. Thanks so much for watching.